So we've been talking about interest rates in the context of sort of, it costs us more to borrow money. The flip side of that is that we can earn more on our money, on our cash and cash equivalents and debt instruments. And Mike, I'm a little bit going to put you on the spot here, but can you give us a sense for instance, what we're earning on money markets right now, maybe what we're earning on shorter term treasury bills? I know it varies, but even if it's a range or a ballpark, it's significantly more than it was for the majority of my time at Albion. And so I think it's just helpful to have those numbers and have those contexts as we talk about it.
Yeah, absolutely. I say this from time to time. It's a good time to be a lender, not a borrower. And even when you have money in a money market fund, which we all think of as cash, you are essentially still under the covers. You're still a lender. You're just lending on a very short-term basis. But so anyway, to directly answer your question, Liz, money market funds right now, depending on the amount that's invested in them, is earning call it 4.9 to 5%, and that's with no price volatility at all, and that's all of that under the covers is invested in ultra safe securities. So we think of that as a cash equivalent, and that, unlike mortgage rates, money market fund yields are directly tied to what the Fed does. So as Jason mentioned, everyone, including Albion, is expecting the Fed to raise interest rates by another 25 basis points here later this month. Within about a week, money market fund yields will reflect that. So by the time we get to the end of July, first week of August, we'll be earning, probably 5.1, maybe 5.15% on money market funds, which is great. Short-term treasuries, and I guess I would use short-term in this context as anything under a year, so call it 3 months, 6 months, 9 month. Those yields are in the 5.25, 5.3, 5.35% range. So even a little bit greater than what we're getting today in money market funds, or what we will be getting at the end of the month. Now those come with a little bit of price volatility, and so there's a little bit of a trade-off there. And then further out, as we look at the bond market, kind of more broadly, and at Albion, generally speaking, if we're, managing a longer term fixed income allocation or bond portfolio for clients, in most cases, we do that with corporate bonds. In some cases, it'll be municipal bonds. That depends obviously on the client's tax situation, but kind of a standard corporate bond portfolio at this point, we can earn a little north of 5%, really over almost any time horizon. So whether that's 1-year corporates or 3-year corporates or 5-year corporates, or even out to 10 years, or however far into the future we want to go. So generally speaking, and again, as Jason mentioned, our view is that inflation over the coming decade, let's say, settles into the 2 to 3% range. If you take the midpoint on that and you say 2.5%, well, if I can get 5% in either a money market fund or a corporate bond portfolio, and my average inflation rate over the next decade is maybe 2.5%, you're getting a reasonable real yield in excess of inflation from fixed income. And that, to your point, Liz, that wasn't the case probably for most of the time you've been at Albion, because we were in this environment of artificially low interest rates. But this is actually sort of, if you take a much longer view of history, this is the normal state of the world. High quality fixed income, believe it or not, is supposed to deliver a real return in excess of inflation. It was just easy to forget that in the decade between the financial crisis and the pandemic, because it was not the case. But we're sort of back to that environment.
Thanks, Mike. I think that context is helpful. Just what the rates are and what we're seeing on those debt instruments. Given where interest rates are, Doug, I'm wondering, can you talk a little bit about maybe planning opportunities or strategies that clients may be able to take advantage of or should be looking at, is perhaps a better way of saying that, in this interest rate environment?
Yeah, so I'm going to leave it really with Mike's point, which is it's currently better to be a lender than a borrower. And most of our clients have a significant portion of their portfolio, at least some of their portfolio, in fixed income. And so looking at that long-term allocation, and for a long time, it was painful to be in fixed income, right? Just from a yield standpoint. Now, as rates went down, the value of those bonds that you had in your portfolio went up. But the main theme is take advantage of these higher yields. Uh, and thank goodness, as Mike pointed out, we're now actually earning a yield that's above inflation, and so that's good news again. And if you look at Albion's planning and what we assume that our clients are going to achieve over time, it's a lot easier to hit those goals with, as Mike pointed out, the bond portion of your portfolio generally being able to hit around 5% a year. So I I think it's a good thing when you're on the lending side. It's a good thing on the investor side. If you do have to, if you are buying a new house, that's going to be painful. Certainly, if you have access, if you refinance anytime over the last 10 years until the last 18 months, it's going to be hard to sell your house and give up that low cost mortgage. So, just work with us. But I think for most of our clients, the higher interest rates and the fact you can get higher than inflation on your bond portfolio, on your fixed income portfolio, is welcome news that we've been patiently waiting for.
Yeah, it's a great point, Doug, about people that have a fixed rate mortgage that was struck when interest rates were much lower. That's the one caveat to my kind of, be a lender, not a borrower mantra. If you're a borrower of mortgage debt at 3% or whatever the number is, I really hope you like your house, because that is a financial asset at this point. And you should not be in any hurry to pay that down. And I will confess that I struggle with this. My Pennsylvania Dutch roots make me very debt averse, and so every month I'm paying like an extra $150 on my mortgage. And every month I say to myself, I really shouldn't be doing this. I should put this money in a money market fund. I can out earn my mortgage rate. So if you're paying a little bit extra on your mortgage, your low rate mortgage, I forgive you. Just don't pay a lot extra.
As we say, the decision to pay off your home or not is one part money and one part, psychological, emotional. So it's hard for it to, to squash those roots, as you say, Mike. I've heard Jason refer to the current environment as the 30-year 3% handcuff with mortgages, meaning if you have those 30-year 3% mortgages, you're probably not doing anything. And as Mike said, we hope you like your house because you probably will want to stay there for a while. Other thoughts on interest rates or opportunities for clients is, in this interest rate environment before we sort of pivot more to a macro topic?
I guess the only thing I would add is, on the borrower side, I mean, if because those fixed rate mortgages at low interest rates are a financial asset, but any floating rate debt, I mean, whether that's credit card debt or a HELOC or a pledged asset line, those have obviously become quite expensive. And so, that kind of creates, if you will, a hurdle rate that you depending on what it is, it could be a challenge to beat that. So for any clients that have that kind of high interest rate debt, it's probably worth a conversation with your wealth advisor as to whether it makes sense to, depending on, of course, on your income and a number of other factors, does it make sense to get rid of that, even if it means using some of your investment assets to do so? So that's a conversation that's worth having. And then beyond that, the only thing I would mention, obviously Albion has been managing bond portfolios for many of our clients for a really long time. But if anyone is on this call that is still kind of in the mindset of, well, fixed income doesn't really pay very much, so I shouldn't bother with it. That's also worth a conversation with your wealth advisor as to, as we've said now many times, the yield environment in bonds has really changed. And even if the right answer over the last 10 years was bonds don't make sense for your financial, your investment plan, it's worth a conversation to see if that maybe the decision is different now.
Excellent points. Thanks, Mike.